Are you sitting on a mountain of equity and want to get access to some of that cash? If so, then you're going to want to watch this video all the way to the end. If you bought your house more than 2 years ago, there's a strong likelihood that you're sitting on a pile of equity, and going into a potential recession, it might be a good time for you to get some access to that equity. And we're going to talk about 3 different ways you can access that today: a home equity line of credit, a home equity loan, and a cash out refinance. Hey, what's up everybody? My name's Dave Gove. I service the North Lake Tahoe and Truckee, California region, and I help buyers and sellers, investors and developers achieve their real estate goals. And today I'm joined by Luke Lewis with Cross Country Mortgage. How you doing, Luke?
I'm doing great, Dave. Thanks so much for having me on.
Yeah, happy to see you again.
Yeah, you too.
So, as you know, my wife and I are in the process of building a house, and we own our condo, and we're not sure what we're going to do with that condo, and we wanted to get a little bit of comfort going into this next potential 12 to 24 month downturn and access a big pile of the equity that we have in there. So I wanted to talk about what some of those options are today. And let's start with the home equity line of credit, or HELOC as it's commonly known.
Okay. A HELOC is basically taking the equity that you have in your property and then opening up a line that you can draw from in order to do renovations, repairs, or just have it as a buffer or backup.
So basically it's like turning your house into a credit card, if you will.
Yeah, your house becomes your own personal bank line. For instance, if your property is worth $1 million, let's just use that because it's easy, and you have an existing first mortgage of $500,000, you have $500,000 in equity in that property. What you can then do is borrow against that equity for rainy day fund renovations, as I said. So you could go up to basically $400,000 potentially in a line of credit against that.
Okay, so if you're wanting to open up that line of credit, is it similar to when you're doing a regular mortgage where you've got to do bank statements and paycheck stubs and tax returns and all that stuff? How does the underwriting and approval process work?
Yeah, the process is very similar. In this case, I have a ton of home equity lenders, and they all have different standards, or they have different documentation in the nuanced pieces, but they're pretty standard. It's the same as a loan because you're taking out a loan or a line of credit. So they want to make sure that you have the ability to repay.
Gotcha. And then how does it work is there any origination fees, any points charged up front? What does it cost to get access to this money?
Yeah, that's a great question. It depends on the bank, very much like if you're shopping for a mortgage. One loan company might have a fee of $1,500. Another might have a fee of $1,600. There are those HELOC lenders out there right now that are doing them at no origination charges. And that's because they're trying to kind of get business right now, because many of these home equity lines, they are based off the prime and then they are adjustable. So it's the prime rate plus the margin. And when the prime rate changes, the rate on the home equity line changes as well.
Okay, so let's say we've gone through the process, we've gone through underwriting, the bank says, yes, Mr. and Mrs. Borrower, we're going to let you get access to this credit line. How is the interest charged? I mean, so right now, like they say, here's your $400,000 in equity and you haven't touched any of it. It's just sitting there, right? And then you say you want to pull out $5,000 to refresh the bathroom or pay your car payments, whatever. How does the interest start accruing?
Yeah, so the interest will start accruing as soon as you have a balance. So
okay.
Say it's $5,000 and the rate is, I'm looking at a rate right now of 7%. It would be, say, the prime rate plus 2.25%, depending on the combined loan to value. So that 9%, 9.25, that is then applied to the $5,000, and then you pay on that. And many of these home equity lines, they're interest only. So if you have a plan for paying them off, you can just eat it and pay the interest. And then if you have a bonus or some kind of cash flow that's coming in, then you can just pay it off at one time. But many people are just kind of sitting and floating, paying the interest only on those.
Gotcha. So you pull the $5,000 out and then you're paying that 9.5% on that amount borrowed on a monthly payment basis, right?
Yep, that's right. And these are amortized depending on the bank, 20 years on the HELOC lines, maybe an amortization of 30 years. And that's when you're going through these, you want to make sure that you got the right fit.
Okay, great. Now, so what's the difference between that and a HELOAN?
Yeah, a HELOAN is basically using the same logic in order to open up the line. You're getting your application, you're identifying how much of a line that you want. With HELOANs, the requirement though is that normally you would take the full draw at the beginning of these, and then you would have a fixed payment. The HELOC is based off of the prime plus the margin, and when prime is changing, that means the rate changes. On HELOANs, you're usually going to pay a little bit more upfront in the rate, but that's going to be locked in. So if you're looking ahead and thinking that the rates are going to be going up, maybe they're going up, and maybe 6 months to 12 months ago, people were locking in these HELOANs and they protected themselves. If they were thinking that the market's going to go down, maybe locking in a HELOAN now wouldn't be a good idea. If we know that, rates are falling, inflation, and we're going to maybe see a dip next year.
Okay. And then the third way that we talked about getting access to equity is a cash out refinance, right?
Yeah. And these were really popular a couple years ago when people were maximizing, the low interest rates and high property values. You'd basically take your first loan, say it will go 500,000 and the house is still worth $1 million. We're taking that first loan and then we're adding to it, say we wanted to cash out 200,000. We would then have a new first loan of 700,000 and you would have 200,000 cash back.
Gotcha. But you're paying likely a higher interest rate, especially if you locked in that mortgage within the past more than 6 months ago.
Yeah, that's exactly right. And then that's where the dance comes in. And what I'm doing with my clients is evaluating, hey, is it a better option to do a HELOC or is it a better option to do a cash out refinance? The beautiful thing about doing the HELOC is that down the road, even knowing that the rates could come down a little bit, consolidating an existing first and a HELOC into one may be a good option. I don't have a crystal ball where rates are going. That's kind of the exit strategy.
Sweet. Okay, so there you have it. 3 different ways to get access to your equity in your home. And if you have any questions, you can reach out to Luke directly. And of course, if you have any questions about real estate in Lake Tahoe or Truckee, you can reach out to me directly. And of course, if you found this information useful, go ahead and hit that subscribe button and ring that bell and leave us a comment. And we'll see you on the next video.